Two people can earn the same income for 20 years and end up living completely different realities. The difference usually begins with one psychological shift. Most people think saving money is a sign of discipline, a quiet form of intelligence. You work, you earn, you spend less than you make. And over time, the numbers slowly rise inside a bank account. On the surface, it looks responsible, safe, mature, but something about it feels strangely incomplete. Because if saving alone created wealth, then millions of hardworking people would already be financially free. And yet most never escape the cycle. Not because they failed to earn, but because they never crossed the invisible line between preserving money and deploying it. That line changes everything. And almost nobody notices when it happens. In the beginning, money feels physical. You can see it, touch it, track it. A paycheck enters the account. Bills leave. A small amount survives the month. That surviving amount becomes the proof of progress. The number grows slowly. And psychologically, that feels rewarding. Because the human brain confuses accumulation with advancement. But this is where the first illusion begins. Because at the lowest level of financial thinking, money is treated like storage, not movement. People save with the mindset of protection. The problem is, systems built around money reward circulation, not stagnation. And that changes the entire game. You can see it everywhere. Banks do not simply store money. They move it. Corporations do not let cash sit idle. They deploy it. Investors do not obsess over the amount they own. They obsess over where it flows. At the surface level, saving looks intelligent. At the structural level, movement creates power. That realization shifts everything. Because now the question changes. It is no longer, how much money do you have? It becomes, what is your money doing while you sleep? That's when things begin to change. At the first level, people save money to feel secure. Emergency funds, safe accounts, predictable routines. And there is nothing irrational about that. Humans naturally seek stability before expansion. But stability has a hidden side effect. It slowly trains the brain to avoid uncertainty at all costs. And wealth has never belonged to people who avoid uncertainty completely. That contradiction creates the first divide. One group spends life protecting money. The other learns how to position it. At first, the difference seems small, almost invisible. But over years, it becomes enormous. Because money behaves differently depending on the mindset controlling it. To savers, money is scarce. To investors, money is a tool. That sounds simple. But psychologically, it changes identity. A saver thinks in preservation. An investor thinks in leverage. And leverage is where the second layer begins. Most people imagine investing as a financial activity. Stocks, real estate, assets, charts. But beneath all of that, investing is actually a perception shift. Because the moment someone invests, they stop seeing money as an object and start seeing it as energy. Something that can multiply. Something that can enter systems and return larger than it entered. This is why the transition feels uncomfortable in the beginning. Saving gives emotional certainty. Investing introduces controlled unpredictability. And the human brain hates unpredictability, especially when survival is attached to it. That is why most people remain trapped at the saving stage for decades. Not because they lack intelligence, but because they associate stillness with safety and movement with danger. But this is where the deeper truth appears. Money sitting still is not actually safe. It only feels safe because the loss happens slowly, silently. Inflation, time, opportunity cost, invisible erosion. The danger is hidden inside comfort itself. And once someone notices that, they can never unsee it. That realization creates the next evolution. At this level, people stop asking how to save more money. They begin asking where capital flows in the modern world. And suddenly, the game expands. Now they notice patterns. Why wealthy individuals own assets instead of liabilities. Why corporations borrow money even when they already have money. Why entire economies reward ownership over labor. At first, these patterns seem unfair. Then they begin to look intentional. Because the financial system was never designed around effort alone. It was designed around positioning. That changes the emotional meaning of income itself. Most workers believe income creates wealth. But at the higher levels, income is only raw material. Ownership creates wealth. Assets create wealth. Systems create wealth. Income simply feeds those systems. And this is where most people get stuck. Because they continue measuring financial progress using old metrics. Salary, savings balance, hourly value. Meanwhile, higher-level players are measuring completely different things. Cash flow, equity, asset appreciation, ownership percentages, time leverage. Different language, different game. And once someone enters this layer, they begin noticing something disturbing. The people who appear richest are not always the most financially powerful. Some own luxury, others own infrastructure. One displays wealth. The other controls flow. That distinction matters more than most realize. Because visible wealth often distracts from invisible power. And investing, at its highest levels, is really about controlling invisible systems. At the next level, investing stops being about money entirely. Now it becomes about behavior, attention, psychology, timing. Because markets are not just economic machines. They are emotional mirrors. Fear moves capital. Greed moves capital. Narratives move capital. Entire industries rise and collapse because human perception shifts. And the people who understand this begin operating differently. They stop reacting emotionally to movement. They observe it, study it, position around it. This creates another transformation. The average person sees financial headlines and feels anxiety. The investor sees structure underneath emotion. One reacts, the other interprets, and interpretation changes outcomes. Because eventually, investing reveals something much larger than money itself. It reveals how systems reward certain forms of thinking. Short-term minds consume. Long-term minds accumulate ownership. Emotional minds chase trends. Calm minds wait for positioning. Most people want immediate certainty, but systems reward delayed understanding. That is why financial evolution often feels lonely, because the deeper someone goes, the more they detach from surface-level behavior. Consumption loses status, patience gains value, and slowly, identity changes again. The viewer is no longer simply observing wealth. Now they are beginning to see the architecture underneath it. That architecture exists everywhere. Technology, real estate, media, energy, attention. The wealthiest individuals are not always the hardest workers. Often, they are simply closest to systems that scale. And scaling changes the rules completely. A worker trades hours for money. A scalable system disconnects money from time. That is one of the biggest transitions in financial thinking. Because once someone sees this, traditional saving begins to feel incomplete. Not useless, just incomplete. Saving protects resources. Investing expands reach. Both matter. But only one changes scale. And scale is where financial gravity shifts permanently, at the final layer. Investing becomes philosophical, because underneath every investment is a belief about the future. A belief that tomorrow will create more than today. That systems will continue moving. That value can expand. In that sense, investing is not only financial behavior. It is psychological optimism under uncertainty. And civilizations themselves are built on this principle. Every company, every innovation, every city skyline, every technological leap, all emerged because someone deployed resources into an uncertain future. That is what separates stagnant capital from active capital. One hides from uncertainty, the other negotiates with it. And maybe that is the real transition nobody talks about. The movement from saving into investing is not really about money. It is about identity. The saver protects. The investor positions. The saver waits for certainty. The investor learns to operate despite uncertainty. And over time, that difference compounds far beyond finance. Because eventually, the person changes too. They stop viewing the world through survival alone. They begin seeing patterns, structures, systems, flows.